Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here, home studios, delivering today's podcast right at the end of May, getting ready to turn over to June here. And I got a lot to talk about today. It was an awesome May. I'm going to provide you guys with some reasons in today's podcast as to why we're very, very excited about the month of June. We'll start with some viewer questions. And I'll kind of wrap up with some thoughts about the markets going forward here. So a lot to talk about today, Ez. Glad you're back here in your home studios. Looks like you've been getting after some projects. Anything going on in your world here today you wanted to share with the viewers?
No, like you said, you can see a little bit of the fruits of my labors in the background, but I'm excited to talk some finance.
That's right. That's right. So for those that might be watching the show for the first time, Ezra is doing all things technical, behind the scenes, video editing. Definitely has a skill set that I do not have. Advanced degrees in art, and that is his world of expertise. Obviously, this show is all about finance. We enjoy doing this together because, like most of the audience, they have a skill set, and it's very likely not finance as their profession. So that's a big reason why we enjoy doing this together. Kind of gives us some back and forth. And then on top of that, the main reason why we really enjoy doing this show, why we've gotten such good feedback, is mainly that we provide some historical perspective on what's going on in the market today. So we'll provide some of that as well. And the reason why that's been important for us here at Shepherd Wealth Management, as well as for all of our customers that we serve, is the news is everywhere. It's on our smartphones, 24 hours a day. We get hit with these headline, news articles, and a lot of them tend to placate the human emotion, fear and greed. We're all hardwired with that. The news understands this, and behavioral finance has taught us that humans feel losses twice as much as they feel good about making a gain, which means that we're risk averse by nature. So if you're trying to sell ads, you're typically going to hit highlights that placate to more that fear of a human that keeps their attention longer. And the way that we get control over our emotions is we look at what history has to say. What have other human beings done under similar circumstances in the past? And that puts some probabilities in our favor. It's definitely not a guarantee in any way, shape, or form. Investing does involve risk, and past performance is not a guarantee of future results. But when we get those probabilities in our favor, now we can start to go about building an asset allocation around those probabilities that so far, coming up here on 3 years old at Shepherd Wealth Management in June. So June 4th, will be 3 years old, and started from zero. And thankfully, we're here and excited today to share with everybody over 90 million in assets. We're coming up on that $100 million threshold, which is it's a milestone. You kind of get knighted in this
Yeah.
industry. So people are like, what does that mean? You hit 100 million. Like, why is it such an important thing? Other than the number itself sounds cool. The reason why it's cool in my world is because you get to register with the SEC, which is obviously a federal government agency. And that's important because we serve clients across multiple states. I think we have clients in 11 different states, I think, at this point. And if you have more than 5 households under management in any one state, you have to register in that state. That's a general rule. There's a couple caveats to that, which means you got to pay the fees and do the processing and so forth. But when you hit that $100 million threshold, you get to register with the SEC. So if I get 5 households in Montana, which I don't, very cool if that would happen though, then I don't have to register directly with the state. I can just send an email to the SEC. They kind of rubber stamp it. So a little less overhead and red tape. So it's very exciting stuff here. I'm very excited to hit that and share that news with everybody when it happens, but we're close. So coming up on 3 years, yeah, it's pretty exciting. I can't believe thousands of videos later, and I don't know how many Sky Mile points and so forth I've accumulated over that 3 years, but here we are, man.
Yeah, well, allow me to say I'm super proud of you. I mean, I've been fortunate enough to have a passenger seat or at least a car seat in the back, you know,
Yeah,
of the van, getting
yeah,
McDonald's along the way. And it's been
right.
awesome to see the company grow. So,
It's cool. We got a lot more growth to do. Certainly appreciate it. We'll do a more formal celebration, I'm sure, at some point. But yeah, definitely. If you like what we're doing, please subscribe to the show. We're on YouTube about every 2 weeks. You can go right to shepherdwm.com. It'll take you to all the information about the company, myself, takes you right to our newsletters that we write every month, our blogs that we typically do every week. And of course, all the podcast stuff is right there as well. So love your questions, love your feedback, and certainly appreciate your support. But with that, I do want to dive into some viewer questions. Maybe not so much viewer. I'm sure that there might be some overlap here between what my clients are asking me about versus what some other people that are just watching the program might want to have us address. So I wanted to start with one thing that we talked about in our last podcast. So NVIDIA is obviously a dominant performer here in the S&P 500, the largest chip manufacturer on the planet, $2.5 trillion. They added $200 billion to their market cap in their last earnings announcement, just I think it was last week or 2 weeks ago. So clearly dominant player, dominant force. And they announced a 10-for-1 stock split, which is coming up here on June 7th, I believe. So what does that actually mean? Why should people care about it? That's the actual question. So stock splits, they shouldn't matter, first of all. So what is a stock split? Let's just make the math simple here. Let's say you got a $1,000 per share stock, and they do a 10-for-1 stock split, meaning that you're going to get 10 shares for every 1 share that you own. In other words, you take 1,000 divided by 10, you have $100 per share stock price, but you just have more of them, right? So you have more shares of the same company at a lower stock price, which means at the end of the day, nothing actually changed in your brokerage account. You still have the same market value of shares. You just have more shares. Now, why that matters, there's 2 reasons, 2 primary. There's a bunch of reasons why a company might do something like a stock split. You could do a reverse stock split. There's other reasons to want to do that. But the primary reasons, typically, when you get a stock that appreciates in value that much, going from, when they IPO'd, less than $100 a share to where they're at today, I would think it's $1,100 a share or close to that at this point in time, that makes it a little inaccessible, specifically to earlier investors. So think of maybe the kids getting ready to graduate high school coming up here, maybe kids in college, kids coming out of college, getting their first job, and they want to be able to participate in the stock market, and they hear all these great things about NVIDIA and AI, and then all of a sudden they look and say, oh, well, I only have like $100 in my brokerage account. I can't go buy NVIDIA shares, at least not a whole share. There are places where you can buy fractions of shares. I get all that. But to buy a full share at NVIDIA and you only have $100, you can't do it. So that's one reason why a company will go through a stock split. It makes their stock more accessible to more people. And just by that, as long as the demand for those shares and their prospects of growth are there, you're typically going to have more and more people buying the shares at that lower price point. Even though it shouldn't matter, people tend to flock towards a stock that is super hot. Think Chipotle, they did a 50-for-1 stock split not that long ago here earlier this year. The stock took off like a rocket. I mean, it's a great company anyway, but just because they did a stock split, the stock again took off shortly after that had happened, just because the shares were more accessible to more people. It shouldn't matter, but and in fact, actually, placates the human emotion. There's a lot of reasons for that. And the other reason why a company might do that is they probably have some sort of stock incentive pay as part of their overall benefit package for their employees. And that just makes it more accessible to more people. They feel better about selling shares at a smaller price, meaning they have to, maybe sell more shares at a lower price versus selling. Let's say they want to go put a down payment on a car, and the down payment is whatever, $5,000. And they want to go ahead and sell some of their NVIDIA shares. Well, they could sell, 5 shares. It'll get them roughly $5,000 today. Or in the future, they'd have to sell substantially more shares. So it just makes it a little easier mentally. Again, this is all human behavior, human psychology. It's called mental accounting, if you will. I mean, we could definitely have a full-blown conversation about that. I mean, you can literally sit through a college lecture just on that simple topic itself. So it shouldn't matter, but it does actually matter the behavior of investors. So I think it was a really good question. It's a very simple one. Stock splits, reverse stock splits are very simple concepts to understand, but there are some strategic reasons why companies will do that, and that is the primary reason. Actually, Jensen Huang, the CEO of NVIDIA, said that specifically. They have stock incentive pay, just better for their employees, and then again, it opens up the stocks to more people participating in the market just due to the fact that it's a lower price point per share, even though nothing would actually change on June 7th with the market cap of NVIDIA in this example, just by doing a transaction like a stock split. So really good question. Other question that came up, and this is actually a Barron's article. This is why this caught my attention and why I wanted to address it. So this is actually an article written today, Elizabeth O'Brien from Barron's. And the article title is Pump Up Your 401k, New Roth Rules Make It Easier. I don't know if these are new rules, but there was some statistic in here that I wanted to share with everybody. So I'm going to talk about Roth 401ks, because what she talks about here really isn't anything new in my eyes. And as a certified financial planner, a guy that had to go sit through a year's worth of studying to be a CFP and actually have to go pass this 2-day exam. This was all the same then as it is today. So I'm not sure where the new rules come into play, except for maybe on the inherited side. So if somebody inherits a Roth IRA that's a non-spouse, I'll talk about that. But other than that, all this stuff is pretty much the same. So Roth 401ks, first of all, if you are an employee working for somebody else, or maybe you're an employer and you just happen to have a 401k with a Roth component, that could be true as well. But for most of us, we're working for somebody else as a W-2 employee in some way, shape, or form. Now, most of you actually have this available to you within your 401k plan. You just might not know it because you're just used to signing up for benefit day, and then you probably don't change too much after that. Now, the statistic here, so Roth 401ks have been steadily growing. 89% of retirement plan sponsors offer a Roth 401k in 2022. This is up from 54% in 2012. So just over the course of 10 years, over 30% more employers are offering a Roth 401k. So if you're an employer or employee and you have a 401k and you're typically a larger employer, you're definitely most likely going to have a Roth option. Now, what does this mean? You have one 401k. You can decide to have some of that money being split up to traditional 401k contributions, meaning that that money goes into that 401k before taxes. So you get a gross paycheck, a percentage of that gross paycheck goes into that 401k, traditional 401k, and it is not taxed. All of that growth is not taxed. Eventually, when you retire or when you hit required minimum distribution age, you'll be asked to take money out of that traditional 401k account. That money will look like a paycheck in the eyes of the IRS, and however much you take out puts you in an income bracket, and that's how that money is taxed. And if you die, that money will also have to be withdrawn by your heirs. Different rules for spouse versus non-spouse, but essentially that money has to continue to come out over time just so you can pay some taxes. Now, the Roth 401k is, again, the same 401k, and you can choose to have some of that money go to traditional 401k. Some of that money can go to a Roth portion of that 401k, or you can select either or. The money that goes to the Roth section of the 401k is after tax. So you get a gross paycheck, your taxes come out, your Roth 401k contribution percentage goes into your Roth portion of that 401k after tax. The benefit of that Roth 401k is this, is all that money grows tax-free when you retire or when you hit required minimum distribution age. First of all, you do not have to take money out of a Roth 401k or a Roth IRA at required minimum distribution age, so you do not have to touch it ever if you don't want to. If you do tap into it, all the money that you take out, assuming that you've had the account on the IRA side for more than 5 years, or if you're taking it right from a Roth 401k, all that money is not taxed at all, including all of the gains. That's a beautiful part of the Roth. What is different with a Roth 401k that you cannot do with a Roth IRA, IRAs are limited to your income as far as what you can contribute to it. Are you allowed to contribute to a Roth IRA or not? So if you make too much money, and for 2024, individuals making upwards of $161,000 or married couples filing jointly making $240,000 or more are not allowed to contribute to a Roth IRA. Now, there's a backdoor way to do that. We'll talk about that maybe a different time. So if you make too much money, you can't make a direct contribution to a Roth IRA. However, if you have a Roth option in the 401k plan at work, it doesn't matter how much money you make. you can still put money into that Roth 401k. And if somebody were to pass, the spouse receives the Roth assets. Again, completely tax-free. They can choose to do what they want to do with it. They still will not have to pay any taxes as they take money out. And if you inherit a Roth 401k or a Roth IRA, a non-spouse inherits, a Roth account, you do have to take the money out over the course of 10 years, but you can wait till the last of those 10 years to take all the money out at once. Again, it's not taxable, but the government just wants that money out of a Roth because they know you're going to have to put it somewhere. It could go to an investment account. It can go to, just spending in general. So you're going to pay, a sales tax, or you're going to pay capital gains tax inside of a individual joint account. So that's the reasons for all that. But it's a really good question. I haven't had it in a little bit. We probably talked about it before, I'm not sure. Maybe earlier on we were starting to do podcasts. But this was a Barron's headline article today, and we got the question. So I thought it was worth spending a little bit of time talking about it, since most of you actually have this as an option. You just probably don't know it.
Yeah, excellent info. I mean, I know that's probably the gateway investing to most working class Americans, right? Is like we either have a Roth somebody sets up for us when we're younger and we forget about it and start putting money into it on our own, or you get a 401k with work. So
Yeah, and I think most of us might agree that typically taxes tend to go up, not necessarily down over time. So it's definitely nice,
yeah.
from a planning standpoint, to have a pile of money that you'll never have to pay taxes on. So I am a big fan of that, of course. Definitely highly recommend that for all those that are maybe not taking advantage of it. We would be more than happy to sit down and go over the pros and cons of that option with you. Should you have those questions, hit me up 513-630-2664. Now, we just wrapped up, or about to wrap up, earnings season. We got 10 companies reporting earnings this week. But of the 485 companies that have reported earnings thus far, which is 97% of the S&P 500, overall, 81% of those companies that have reported are beating their estimates, and the median beat rate is 8%. So, really stellar earnings results. Earnings estimates are still creeping up, which again is helping the market not get overvalued. So it's really, really good stuff. Led the way by tech, and we kind of talked about the reasons for that in our last podcast. If you missed it, it was a good one. Definitely go back to shepherdwm.com, find that YouTube channel on the website, and take a look at that. So we certainly spent some time talking about that. Now, I want to talk a little bit about some stuff that I sent out to our clients. So again, I mentioned this at the top of the show. We write a monthly newsletter, and in that newsletter, we just kind of summarize what happened the prior month, why things happened that way, what does history have to say about it, and then we give our thoughts and perspective on it, of course. But on Fridays, it's not perfect every Friday due to travel or vacations or whatnot. Market could be closed on a Friday too. But on most Fridays, I tend to write a weekly blog. And in this blog, I try to keep it short, about a page, maybe a page and a half, putting a lot more pictures, in the blogs themselves to kind of keep things simple. Got some feedback on that, and people like it. But in that weekly blog, we're just kind of trying to summarize, again, what happened that week, why did it happen, what does history have to say, and then what are our thoughts on that. And in the last blog, I just wanted to point something out here, to individuals that may have, not a current, client here at Shepherd Wealth Management, maybe missed the posting of this blog, but there is some statistics, and there's this thing called a Harrison poll. This is just a poll that kind of surveys individual investors across America, and they give them some pretty simple questions here, I think. And I think this is classic behavioral finance, like at work in front of human eyeballs, like in real lifetime. So in this Harris poll, I bet that you will appreciate this and get something out of it, which I'm hoping everybody else does as well. So this Harris poll says this: 55% of Americans believe the economy is shrinking. Right? I mean, I'm not sure where these Americans are coming from, but we're getting growing GDP estimates almost on a monthly basis. 49% of Americans, almost half, believe that the stock market is down for this year.
It's not.
Uh, it's up double digits.
We're still in the bear.
Right. I mean, this is no joke. I mean, this is the reason why there's $6 trillion still sitting in cash. Believe it or not, double digits year to date. I'm going to give you 5 reasons why I'm going to expect a lot more than that here by the end of this year, in the back half of this year, coming up here in just a second. But almost half of Americans believe that the market is down for the year. It goes on to say 49% of Americans believe that the unemployment rate is at a 50-year high, although we know the unemployment rate has been near a 50-year low for quite some time. So to me, when I see stuff like this, and I highlighted this in the blog that I sent out to our customers, I simply said this. I said this is classic behavioral finance at work right in front of us. People read headline news and they take it as gospel without actually doing any research or looking at any historical precedents at all. I mean, this is real life stuff. This just came out last week. So this is definitely top of mind kind of information here from a polling perspective for American investors. And I simply said the bottom line for us here at Shepherd Wealth Management, our clients, yeah, we lead with service because we can control your experience here, which is why we spend so much time doing this stuff and doing quarterly reviews in person. But the real secret sauce to the success is that the historical lens that we look at the market through is a huge advantage for our clients. Like if you just look at the headline news, you're going to come to the similar conclusions that the majority or almost the majority of Americans have come to based on this Harris poll. Now, I don't want to get too far down my 5 reasons, but I'm going to give you kind of one of the reasons here right up front. And then we'll talk about, how this plays into the other 4 reasons we're really excited about June specifically. And then I'll talk about the back half of the year as well.
Hey,
So this is
Joshua,
a,
sorry to
go
interrupt.
ahead.
Just before you keep going, I'm just curious about this poll because this kind of blows my mind. Like things, I don't want to say they're booming, but um, that's just such a high percentage of negativity and just like a complete lack of reality in the results of that poll. I'm just curious, like who are they actually asking those questions to? You think that skews the answers?
Yeah, so the Harris Poll is an American market research and analytics company that has been tracking the sentiment, behaviors, and motivations of American adults since 1963. It's been around for a minute. Harris also has developed software data platforms that allow brands to track health and campaign success. They don't just take a poll of everything. It looks like they do some other stuff here as well. But they've been around for a while. The
Well, their
Harris
idea of
poll.
adults is that like people who are, and this includes my father, who I love, but like people who are 75, maybe not taking good stock of what's going on, or people who are 20, because it just
Yeah, that
seems like such a misnomer from what's actually happening. You know,
I didn't look at the dispersion of age that they took this poll for. What I do know is, again, they've been around for quite some time, and I believe since they've been around for so long and so reputable, that they take a true sample size, and you can't just take it from one cohort of the population, right? That wouldn't make any sense to me.
yeah,
Um,
100%.
so
I
I'd have to take a
appreciate.
look at that.
Well, I appreciate you letting me jump in there. I'm just so flabbergasted by that answer. I don't distrust the Harris poll at all. I just like, yeah.
Crazy, right?
Well, yeah, it is crazy. So on to the 5 reasons. On to the 5
Yeah, I mean, this is I can't make this up. Like this is real life. Go Google it. You'll find these same statistics that I found. Um, Now, I did find a data set though. This is data set going back to 1927 through present day, so pretty good sample size. And when the S&P is positive in the first 3 months of the year, just like this year, and April is negative, just like this year, the S&P 500 is positive 73% of the time in May, and 100% of the time in June, with a median return of 3.9% in the month of June. So this is part of the reason why we're so excited about the month of June. But more importantly, I bet you've heard of this as, I bet a lot of people have heard of this. You hear this phrase every year in May, before we get to May, sell in May and go away, right? Well, again, if you look at what history has to say, you would know coming into May, based on this precedent since 1927, that there's a 73% probability that May is actually going to be positive.
Right.
Well, so far, month to date, May is up over 5%. So it's even done better than its historical averages, which is why we look at probabilities and averages. Could be better or worse, but at least you understand what the probabilities are before you even get to a particular month, quarter, or event like an election or interest rate changes or whatever the thing is. There's a historical precedent for it. This is where our edge comes from here for our customers. And we spell this all out in very simple terms for them to understand. At least I hope it's simple as we deliver this podcast. I like to think it is. I know we cover some of the material kind of fast, but this is, again, I cannot make this up. So all these people that from the Harris poll believe the economy is shrinking. Half of them think the market's down, even though it's up double digits. Half of them think the unemployment's at a 50-year high when it's at a 50-year low. This is just us having very busy lives, or just so distracted with life itself. And we see these little headline news hit our phone or email, or just simply just pops up on your computer as you're going about your day, searching things on Amazon maybe. And this is how people come to conclusions. But this is why my job matters, why I take a lot of pride in it, and why I love doing the show, is so I can provide you guys with some historical context before you just jump to a conclusion that everything's so terrible. And this $6 trillion that's still sitting on the sidelines since last year, I mean, it's missed out on more than double-digit gains. We're talking about returns that you can't really get back very easily. And by the time all these individuals start to participate in the market, that's where you're going to see your frothy moment, if you will.
Yeah.
And you got to take the words of Warren Buffett very seriously at that point. He wants to be greedy when others are fearful. Clearly, there's a lot of fear in the market, even though we're up double digits, even though we came off a year of double digits, even though the historical precedents and statistics make it very plain and clear that this is going to be a really good stock market year. It already has been. Outside of some sort of geopolitical event that could happen at any time, under any circumstance, under any year. So it's a risk that nobody can diversify away from. Outside of that, I really don't know where all the fear is coming from, except for the fact, I mean, the only thing that makes any sense to me is that people, again, are so busy that they just look at these headline risks and they take it as gospel, and they don't do any research on their own, and they end up missing out on a lot of opportunity. And this is, to me, a huge reason why most Americans retire without being fully financially prepared, right? The average American in this country, unfortunately, retires with about $255,000 at the age of 65. Now, unless you are a very frugal individual, or maybe you have all your debt paid for and you got Social Security, I really don't see how that could get somebody through potentially, 35, 40 years of retirement, specifically when prices tend to go up, not down, taxes tend to go up, not down, healthcare costs tend to go up and not down. So this is, to me, a big reason why most Americans just simply are not prepared. And, the truth of the matter is, I think Bill Gates said it best. If you're born in this country poor, it's definitely not your fault. But if you die in this country poor, and poor is, relative, right? It kind of is your fault, because there's so many opportunities. If you're not satisfied with where you're at financially, health-wise, or whatever your thing is, you're not satisfied with, there's a way to address that right here in this country. And a lot of that has to do with you as the individual wanting to make those changes, wanting to admit that you need some help, wanting to have something better, and working alongside others tends to allow that to happen more effectively. So this is why I point all this stuff out. I'm not here to bash anybody and their decisions, but when I see something like this, all I can think of, this is behavioral finance playing out in real time in front of everybody. And it's a little sad, to be honest with you. But that's one of the reasons why we're excited about June, is from a historical perspective. But I want to get to the other reasons as well. So I just talked about the first one. It's a high probability that we see positive results in June. based on what history has to say. Second, I think we're about to see some favorable inflation data. So on Friday, tomorrow, 8:30 Eastern Standard Time, we get April core PCE, and this is, of course, the Fed's favorite measure of inflation. I believe that we'll have a softer reading, much like we've seen here from PPI as of most recent. And then a little bit later, next month on the 10th of June, we get the New York Fed one-year inflation expectations, followed by on the 12th of June, 8:30 in the morning, we get the May CPI. So between tomorrow and mid-June, so over the next couple of weeks, we're going to learn a lot about where we stand on the inflation front. So we had 3 months. We pointed out the reasons why we saw higher inflation numbers, at least on the headline CPI, the first 3 months of the year being propped up by auto insurance and shelter, whereas the other 55% of the components that make up the headline CPI are in fact falling quite a bit and trading or settling below their historical averages. I'll talk about that here in just a second. So I do expect a positive, meaning lower or inline inflation numbers coming up here over the next couple of weeks. Third reason, there's low utilization of leverage measured by the New York Stock Exchange margin debt. What we mean by this is if people are calling for a top in the market, well, generally one of the things you want to look at to see if there's a top is how much margin debt are people leveraging. The more leverage investors are taking, the more prospects they see for growth, or at least they feel good about the prospects of growth. So therefore, they're willing to take on some margin leverage to maybe benefit substantially from that growth they perceive to happen here. Well, when that margin debt is below historical averages, it's really difficult to call a top, right? Investors are both hardwired with fear and greed. And when that greed part starts to take over, you tend to see leverage go up. And that's generally speaking where you might start to want to take some of those profits off the table. We're just not seeing that from a leverage perspective. Fourth, there's, again, $6 trillion and growing on the sidelines. And of course, I think those investors will finally capitulate and understand that they've missed out on a huge opportunity. And you'll see this fear of missing out actually kick in and a lot of that cash getting put to work. And last but not least, we talked about this in our last podcast, but we've seen in our earnings season, is showing that the AI spending, that AI transformation is still extremely strong. And I expect that to continue, not just for NVIDIA, but for all the companies that are kind of derivatives, of an NVIDIA, things like a Supermicro that makes the servers, Veritiv Holdings, which makes parts that keep all those servers cool. I can go on and on about other companies as well, but you're seeing that in this earnings season that spending is still extremely robust and likely to continue for the foreseeable future. So those are our primary reasons why we're pretty excited about the market. Now, one of the things I wanted to touch on here real quick too is we talked about in our last podcast, again, 2 components of the CPI, the headline inflation number, that are propping up inflation that looks like it's more sticky than it actually is. One of those is shelter. And just yesterday, we got a Case-Shiller home price update from March of 2024, and it shows that home prices rose 0.33% versus consensus of 0.3. However, this is down from last month's 0.55. So it's a pretty good drop month over month. The year-over-year growth rate for housing is slowing to 6.49. And this is again down from last month's 6.53. The issue is, and this is what, again, we're not seeing any of this in the news. I haven't heard one person talk about it. This is the issue, is that this index, although very factual and relevant, real-time sort of data, Case-Shiller leads shelter CPI by roughly 17 months, right? So eventually, this is going to show up in the data. Now, the Fed knows this. I'm not the only person in the world, that can read this and look at it from a historical perspective. This is one of the reasons why the Fed is being patient as far as their decision-making with what they're going to do with the interest rates. But I thought that was worth pointing out as well. The other thing that stuck out to me from a research perspective, and this is looking at, hedge fund exposure to both cyclical versus defensive sectors, is at an all-time low. So cyclicals would be like energy, tech, industrials, materials, and defensive sectors would be like healthcare, utilities, and staples. And right now, hedge funds are basically not participating in a lot of the defensive stuff. So they at least are participating in the cyclicals. They probably have more cash than they should have, trying to catch up with the S&P 500. But the hedge funds are not in defensive mode from a positioning standpoint. That's a pretty good indicator as well that there's some pretty good prospects for growth. Those were the main things that stood out to us as to why we are so bullish on the S&P 500, not just for the month of June. May was a fantastic month, even though a lot of investors, went to cash, as we've already highlighted here a couple times over now. But it's also a big reason why we're very excited about the back half of the year, because if you do continue to see, robust GDP, strong earnings, low unemployment rate, and as long as we don't get, again, some sort of shock, a geopolitical event that just rocks the market, has oil prices spiking to $100 plus a barrel, something dramatic like that, which again, nobody can diversify away from. As long as we don't have anything like that and we get an interest rate cut or two, and quite frankly, even if we had no interest rate cuts, you're very likely to see a really good outcome for the market. The only thing that would really throw a lot of cold water on that is if we had to have a real serious conversation about increasing interest rates to stave off the pressure that inflation may be putting on interest rates in the overall economy. So I'm just not seeing it. You're really not hearing that from Fed Chair Jerome Powell at all. You will get some additional insights from him here coming up pretty soon. And of course, we won't have to wait very long at all here at 8:30 tomorrow morning. We'll all know what the Fed's favorite measure of inflation is going to look like. And of course, that's going to move the markets one way or another. So I'm excited to see what that looks like. I'm excited for June, very excited for June based on a historical precedent. And I'm very excited for the back half of the year because I do think this inflation data is going to start to sync up in a positive way, which will allow the Fed to eventually cut rates, and certainly will be a huge tailwind for the stock market if it continues the earnings growth that we're already seeing. So a lot of reason to be excited, although most of the market isn't. And it seems like half of America seems to be ignorant to the fact that it's already been a really good year. So we'll see how things shake out.
Well, I
But
certainly haven't minded seeing the green on my investment accounts. I don't know what everybody else is looking at.
I don't know. I'm not for sure, but I wish I could talk to all market participants directly and all that, but that's just not the case. But I
Yeah.
am enjoying the market participation that we've had so far. I know our clients have as well. We just wrapped up all of our quarterly reviews. Everybody's pretty excited and everybody's pretty dang happy. Therefore, I am happy. So we'll continue this every 2 weeks,
Yeah. Well, I
and
will
hopefully,
say before we sign off, this being present for these conversations has certainly helped alleviate any of the behavioral finance issues I was dealing with. And even when things, do seem like they're taking a slump, it's having this conversation and being present with it has really made it easy for me to do any kind of my dollar cost averaging or just kind of staying up on the data and not freaking out. So I have you to thank for that because, as you mentioned at the beginning of the show, I am completely ignorant when it comes to investing, although maybe not so much now after doing this for a few years.
I'd
Um,
say that you're about ready to take on some client sets. Um,
hey, maybe I need to just kick all this art stuff out the window and get some certifications or some
yeah, we just got to
associate
get you through
degrees.
a couple licensing exams, and you'll be all set, my friend.
Yeah, but that
Um,
also, you brought this up at the beginning of the episode too. That's another. I just want to remind all the listeners, or everybody out there who either is joining us right now or is going to find this episode later. This is an active and working firm, and Joshua's talked about all the amazing growth that SWM has seen over the past 3 years, and that's certainly very exciting. But I think it's also something to be said for why you put all this information out to the public, because even though you are guiding your specific clients, they're not in a monolith or some kind of echo box, right? That they're still accountable to the same economic situations and market risks that everyone else is. So despite the fact that this is geared towards the Shepherd Wealth Management clients, it's very valuable information for everybody. Like I just said, how it helped me. So whoever's finding this episode, or no matter how far into the future you're here, leave, if you have questions, either text the number that's sitting up at the top of the screen, point to it right here, 513-630-2664, or leave a comment anywhere that you find the postings on Spotify, YouTube, or whatever. And Joshua will answer you. He'll get back to you. So
Yeah, it's a lot of fun. I enjoy it. This is what I was planning to do. So I'm having an absolute blast doing it. And we'll keep doing this. No reason not to. I mean, there's a lot of people out there that I think could benefit, not just from the podcast information itself, but again, I'm looking forward to continue to grow this firm. I think we'll be around as long as we want to be around at this particular point in time. So we're really appreciative of all the support from our customers, all the fans, and everybody else out there that isn't a current customer. There's definitely a place for you here. We'd love to have you. So with that, we'll let you guys get back to your day. It was a lot of fun. We'll catch you in a couple weeks with some fresh inflation data to talk about. And until then, I hope you guys have a great rest of your day. Take care.